The CME just cut silver margins again, and if you know what that means, you already know why this is one of the most bullish signals the silver market has produced in years. If you do not know what it means, by the end of this video, you will. And you will understand exactly why this single decision by the world's largest derivatives exchange could be the catalyst that sends silver into a full-blown bull run. My name is Stack AG. Let us get into the data. Before anything else, let us make sure everyone understands what margin actually means in the context of futures trading, because this is where most people's eyes glaze over. And that is exactly why most people miss the significance of what just happened. When you trade silver futures on the CME, you do not pay the full value of the contract up front. You pay a deposit, a fraction of the total contract value. That deposit is called the margin requirement. Think of it like a down payment. If silver futures require a $10,000 margin, that means you can control a contract worth $100,000 by putting up just $10,000. Now, when the CME raises margin requirements, it becomes more expensive to hold silver futures positions. Traders need more cash to maintain their positions. Many smaller traders get forced out. Trading volume drops. Price often falls. When the CME cuts margin requirements, the opposite happens. It becomes cheaper to hold silver futures positions. More traders can afford to enter the market. New money flows in, volume increases, and price, historically, tends to rise. A margin cut is the CME saying, we want more participation in this market. We want more traders. We want more liquidity. And when you cut margins during an already rising silver market, you're essentially pouring fuel on a fire that is already burning. So what exactly did the CME just do, and how significant is it? The CME reduced the initial margin requirement for silver futures by 22%. 22% in a single adjustment. To put that in context, a 22% margin cut is not a routine adjustment. Routine adjustments are 3%, 5%, maybe 8% in unusual circumstances. 22% means the CME made a deliberate, significant policy decision about the silver market. They looked at the current conditions, the vault drainage, the industrial demand surge, the price momentum, and they decided that silver liquidity needed to be increased substantially and immediately. Now here's where it gets interesting. Historically, large CME margin cuts in silver have preceded major price moves. Not always immediately, but consistently. When the exchange reduces the cost of participation, new money enters. New money creates new demand moves price. The last time CME made a margin cut of this magnitude in silver, the price was in the early stages of a move that eventually saw a silver price double over the following 6 months. That does not mean it will happen again. Markets never repeat exactly. But patterns in markets exist because human behavior in financial systems tends to follow similar logic under similar conditions. And right now, the conditions are remarkably similar. Now, here's the part that financial media never explains properly. Why does the CME actually cut margins? The official answer is liquidity management, making markets more accessible, improving price discovery. The real answer is more nuanced, and understanding it gives you a significant edge. The CME is a for-profit business. It makes money on transaction volume. More trades equal more revenue. When silver is in a bull market, the CME wants maximum participation because maximum participation means maximum revenue. But there's a second reason that is even more important right now. When physical silver is leaving COMEX vaults at record pace, as we covered in our previous video, the CME faces a potential problem. If too many futures contract holders demand physical delivery simultaneously, and there is not enough registered silver to meet those demands, the exchange faces a credibility crisis. One way to manage that risk is to encourage more paper trading relative to physical delivery. Lower margins mean more paper traders enter the market. More paper traders means more contracts being closed out for cash rather than physical delivery, which reduces the pressure on physical inventory. So the CME margin cut serves two purposes simultaneously. It increases trading volume and revenue, and it subtly manages the physical delivery pressure that is building in the registered vault system. Both of those things are happening at the same time right now, and both of them are ultimately bullish for silver price. So, the question in today's title, is the bull run confirmed? Honest answer, no single indicator confirms a bull run. Anyone who tells you one data point guarantees a price move is either wrong or selling something. But here is what I can tell you with confidence. We now have multiple independent signals all pointing in the same direction simultaneously. And when multiple independent signals align, the probability of a sustained move increases significantly. Signal 1, COMEX vault drainage. Physical silver leaving the paper market system at record pace, bullish. Signal 2, China accumulation. A sovereign nation buying 500 tons of silver per quarter, bullish. Signal 3, industrial demand at record levels. Solar, EV, semiconductor demand absorbing supply faster than miners can produce it, bullish. Signal 4, CME margin cut. Lower barriers to entry, bringing new money into silver futures. Bullish. Signal 5. Gold-silver ratio at historically elevated levels. Silver historically cheap relative to gold. Bullish. Signal 6. Dollar weakness. Federal Reserve rate cut cycle reducing dollar appeal relative to hard assets. Bullish. 6 independent signals. All bullish. All happening simultaneously. Is the bull run confirmed? No single data point confirms anything. But 6 aligned signals? That is not noise. That is a message. Let me show you what happened the last time we saw this combination of signals. 2010 to 2011. Silver was trading around $18 per ounce. COMEX inventory was declining. Industrial demand was rising. The Fed had just completed a massive quantitative easing program weakening the dollar. The gold-silver ratio was historically elevated, and the CME had recently adjusted margin requirements. Show graphic, silver price chart, 2010 to 2011. Over the following 14 months, silver went from $18 to $49 per ounce, a 172% move. Now, I am not predicting a 172% move from current levels. Markets are different today. The starting price is different. The global context is different. But the structural similarities between 2010 and today are undeniable, and understanding history does not guarantee the future. But it dramatically improves your ability to navigate it. The last time these signals aligned, silver nearly tripled. That fact alone is worth understanding. Standard disclaimer: nothing here is financial advice. This is data analysis and education only. Always consult a qualified financial professional before making investment decisions. Now, practically speaking, what does the CME margin cut mean for different types of silver investors? If you are a futures trader, lower margins mean you can take larger positions with the same capital. That is a double-edged sword. More leverage means more potential gain. It also means more potential loss if the trade goes against you. Size positions according to your risk tolerance, not according to how bullish the data looks. If you are a physical silver holder, the margin cut does not directly affect you, but it affects the price discovery mechanism that determines what your physical silver is worth. More participation in futures markets generally means more accurate price discovery. And if that price discovery is happening in an environment of genuine physical scarcity, it means prices will need to reflect that scarcity more accurately over time. If you are on the sidelines considering entering, understand that margin cuts create momentum. Momentum attracts more participants. More participants create more momentum. This cycle can sustain price moves for weeks or months before reversing. Timing any entry perfectly is impossible. Building a position gradually over time is the logical alternative. And as always, we do not sell silver. We do not sell anything. Anyone contacting you in our name, offering products or investment opportunities, is a scammer. Block and report immediately, a 22% margin cut. 6 bullish signals aligned simultaneously. Historical precedent showing what this combination produced last time it appeared. The silver market is sending a message right now, loudly, clearly, to anyone paying attention. Whether this becomes the bull run that silver investors have been waiting years for, or whether it consolidates further before the next leg, the direction the data points is unmistakable. Stack AG will be here every single day tracking every signal, every vault report, every margin change, every sovereign purchase, every macro shift. So you always have the data before the mainstream does. Subscribe, hit the bell. Share this with one person who needs to understand what is happening in silver right now. I am Stack AG. Invest with logic, not hype. See you tomorrow.